Has history ever shown that we've got to maybe 8 o'clock or 9 o'clock and then we've missed out on the boom and we've gone back with, I guess, a double dip we're talking about? How does the clock address the idea of a double dip recession?
Well, I think the issue there, very much relies on, what happens in the context of the world and what effect that's going to have on, countries like Australia. But, even in the current context of time, Australia's now got China and India, very much supportive of our industry here and very much in demand for products and services that we can supply from Australia. So that, has changed the position of today, whereas 20 years ago that situation, hasn't existed. So Australia's sort of in some ways disconnecting itself a bit. So we're less likely, to be dragged down to the same degree. And of course you've got the US, which is still, very much trying to come out of the recession.
And doing a reasonable job. The economic data has been pretty good.
It's been pretty good, but they've got still a very high unemployment rate. Ours has dropped to 5.3%, which has surprised everyone, because the original government estimates had it going up to 8.75. So all those indicators, are pretty good. But I think in the sort of broader context, if you look over, say, 100-odd years of the share market, you've seen that we've always come back and then surpassed the previous high. But in some senses, that can take 3, 4, 5, up to 8 years to do that. It's never going to be the same. No. But I mean, it's quite conceivable.
So in a sense, the clock is not symmetrical. It can be stretched on one side and shorter on the other.
It can be, and it's not unlikely to sit here and say to you today that sometime in the next 4 or 5 years we could see an all ordinaries index of 10,000 from the current level.
We'd all like to see that, unless we're short sellers.
Which would be good, because I can remember back in 1987 when it got to 2,800 and then dropped to 1,650, and that seemed pretty high then.
Most definitely. Now, is there any other information that you've brought along tonight that you'd like to show us in terms of analysing what the market's done so far?
Well, we had a chart of the All Ordinaries Index which shows, what markets have done over 110 years, because I think people then see in the context generally of when is a good time to buy and when it's not. And
here it is now.
It's showing you this now, and this takes you back to 1914, and it shows sort of pivotal points. The Wall Street collapse of 29, right through to probably one of the most memorable crashes in Australia in a world context was 1987. And as we were just discussing, the index got to 2,800 then, and then dropped to 1,650. So that was a drop of about 50%. And then what we've seen with the global financial crisis was our market drop from a peak in November 2007 of 6,800 down to 3,109 in March 2009.
And well, what's really interesting, if you look at the climb out of 73, it was a very steep climb. It's very similar to the kind of slope that we're seeing now out of 2008, isn't it?
There's been quite a bit of analogy there and analysis on that, as you say, because we've kicked out of that quite quickly, and it's even indicative of perhaps those business indicator figures that came out today, which were really showing that we're back. If those figures are indicative of where we were back in late 2007 with the resources boom, there's those figures of 6.1% indicate we're back to that.
So the Westpac index, the leading index, suggests that within, say, 9 months we could be at a 6.1% growth rate, which is extraordinary. But we're currently only around 1.9 on the coincident index. So that means that this year could be a boom of a year, which could mean inflation and could mean interest rate rises.
Exactly.
As well.
There's always a bit of bitter pill, to come with it as well.
Okay. What analysis have you done on the kind of recovery on the stock market we've seen so far?
Well, it's interesting because even when you look at what's happened over the rise during 2009 of 50-odd%, it's really been very much focused on the top end of the market and very few stocks. And we've done quite a bit of analysis to sort of show, which stocks have performed best, and out of those sort of top 10 stocks, largely a few of them have been the ones that have increased the most, and we certainly saw the banks through 2009 increase over 100%. But the broader market really is still to sort of move up, and of course the smaller end of the market, the small cap sector, there are many stocks there that have largely been illiquid over the last year or so, and we're starting to see a little bit of impact come back there. So I think generally as markets rise, the value sort of moves down the market cap range, and I think there's probably some fairly attractive companies to look at that have taken the opportunity over the last year or two to batten down the hatches.
Certainly a lot of people who've come on this program have kept reinforcing the message that there are a lot of value companies that have been ignored. And this could be the year for stock picking as opposed to just simply riding up the index. I'm a little bit in both camps. I think the index will do well this year, but I also think there is some great value down there. But you have to have certain skills to pick it out. What's your view on it, Rod?
Well, I think you've got to be very careful at selecting a lot of those stocks. But generally, I think they're the companies that are likely to perform, in a market that's increasing, and they're companies that have, got reasonable and substantial cash positions and the ability to generate cash. So you can apply, sort of 6 or 7 different principles and overlay those on those companies. But the interesting thing that I find is that because we've been going through a difficult period over the last year or two, a lot of companies have really been forced to tidy up their balance sheet, in some cases contract, their workforce, and improve how they do business. And of course, when recovery kicks in, the economy and people start to spend more money, those companies' earnings, generally moves more quickly, in the up cycle.
Okay, well, we're nearly out of time, mate. So just to put you on the spot, where do you think the index might finish this year?
I think we'll finish around 5,300 would be my tip. I don't think the rate of pace is going to be as significant as it was over the last 12 months, because we're going to come off the back of the reporting season now, which has been great for the half year, up to 31st of December. I think the full year results will be quite good, but I think we'll come in, just over sort of 5,300 by calendar year end.
So it'll be a nice rise, that's the case, probably around 12 or 13%.
Yeah,
plus dividends. It could be a very good year for people.
Which is pretty healthy.
Yeah, without a doubt. Well, always great having you on the program. Best of luck. See you pretty soon.
Thanks, Peter.
A massive lesson has been brought home today when Colonial First State said it was going to shut down